Welcome back to a brand new content video. In today's video, I'm going to be describing exactly how to use multi-time frame analysis in the most simple way that you're ever going to see using the RIMC model. Just a quick reminder before we start, the brand new Flawless Execution Psychology course is now out and available for all NJT members. We've also brought out a brand new Trade in Missing Pieces video. That is our advanced price action course. So if you like the concepts that you're seeing in today's video and they help you, make sure you go and watch both of those. If you are struggling to execute a trading strategy consistently, that is exactly what the psychology course teaches you, that mental management program from start all the way to finish to executing a trade absolutely perfectly so that your strategy has the opportunity to play out in your favor. So make sure you have a watch of both of those if you haven't yet. Right now, I just touched down into Jakarta, Indonesia. I love this place, such a great city to be in. This city feels like the Barcelona of Asia, so absolutely love it here. I know there's so many Indonesian traders that also watch as well, so big up you guys. And let's get straight into today's video. So I'm gonna break this down for you as simply as I possibly can, right? Time frames is a very simple concept to understand. I think people overcomplicate time frames, thinking that they have to look at every single time frame to gain an understanding of direction. Now, when you're utilizing the RIMC model, you need to understand two major time frames. One is your higher time frame, and then the second one is your lower time frame. Really and truly, you only need those two time frames in order to trade or get a bias on direction. So what I normally do is I use the monthly, weekly, daily, and 12-hour. Those are considered my higher time frames, which I'm looking for RIMC on, right? So this is a sideways range here, where prices contain sideways. Of course, this is a sideways range inside the sideways range area here, which we can refine this entire sideways market into this specific location on the charts here. Now we take the lowest point to the highest point of the sideways range, and that gives us the area that price is going to react from. Then what I'm doing is when price comes into this location here on the lower time frame, I'm zooming in at this location. I'm waiting to see manipulation, or I'm waiting to see price slow down here. And then I'm not just taking the trade right at the top of the market trying to catch this monthly range high. What I'm doing is I'm waiting for price to show its intention and show me continuation structure, because continuation structure is showing that price wants to move in a specific direction. If price wants to move higher, it's either going to explode higher or it's going to move in a trend higher. These are the only two ways that price moves higher. So if we can identify a higher time frame sideways range or a higher time frame area that price is going to turn from, when we zoom into our lower time frame, this is what we need to see: continuation structure away from this location. So that's what I'm utilizing the time frames for. I'm utilizing the RIMC model to gain an understanding of the sideways range on the higher time frame. And the reason that I'm looking for that range on the higher time frame is because I'm not trying to catch 5 to 10 pip moves. If I was going to try and catch 5 to 10 pip moves, I'll just use 15-minute sideways ranges and I'll look for continuations on the minute or the 15-second. I want overall direction for a few days. So when we react from these higher time frame ranges, we're potentially moving 2, 3, 4, 500 pips just as a reaction. Now, if we do end up following through and continuing that direction for a long time, we've got thousands of pips worth of a direction. So if you start your analysis on the higher time frame and you look for the RIMC model on the daily, the weekly, the monthly, the 12-hour first, and then you utilize something like the 15-minute chart for your continuation structures away, or you utilize something like the 1-minute chart for your continuation structures away from these locations, you're maximizing your potential without using the risk of having to call the high or call the low from any of these areas here. So let me explain that, right? If you had tried to just trade the reaction from any of these areas from this monthly range that we have up here, this range is nearly 200 pips worth of movement. Now, if you're trying to catch a trade with, let's say, anywhere between a 5 to 10 pip stop loss, which is a very tight stop loss, considering that this range is 200 pips, a lot of the time you're going to get taken out of a lot of trades. So instead of doing that as a reaction, if you look for your continuation structure away, because you know that price has to move hundreds of pips from a reaction, you don't have to be so specific. You can actually wait for the market to tell you that it wants to move in that direction, and then you can catch a pullback and a continuation. Now, if price moves very aggressively, because sometimes we do get very aggressive moves down like this here, then instead of looking for that trending market structure away, you'll just be looking for a new sideways range to be created to play the next continuation to the downside. So essentially what you'll be looking for is manipulation to be created, a new high volume area to be created in current price, and then you'll be playing your continuations away, right? With the understanding that price isn't going to trend, actually we're going to see a volatile market. And I'll take you through some examples in a second on the 15-minute chart, but this should be the core of exactly how you analyze the markets from the higher time frame to the lower time frame. You don't need the monthly, the daily, the 8-hour, the 4-hour, the 1-hour, and the 15-minute all to line up to take a trade. You just need a reaction area from one higher time frame, or a representation of the RIMC model on one higher time frame, like a monthly, weekly, daily, 12-hour. Then on your 15-minute chart, or your 1-minute chart, or your 5-minute chart, whichever chart that you trade, you need continuation structure away from that higher time frame sideways ranging area. That is it. You just need those 2 time frames and you can build a high probability trading idea every single time. That is the idea behind all of the trades that I take. I keep it as simple as possible. Yes, I still look at all of these other time frames, but they're just adding to the bias that I've already built from these higher time frames. And the reason that I start on the higher time frames, I know we're going through a lot of theory stuff first, but the reason that I start on the higher time frames is because the higher time frames are showing the direction. They're building the direction. Price is always following the higher time frame narrative for either higher prices or for lower prices. So if we can understand that perspective, and we understand that the higher time frame sideways ranges and the reactions is what price is following, then the lower time frame delivery at these locations, let's say on the 15-minute, the 5, the 1, is going to build price delivery to support that overall higher time frame direction. Now, in order to support that higher time frame direction, it would have to create a trend or an initiation in that direction, because that's the only way that price moves lower, or the only way that price moves higher. So now our minds are aligned with how the price actually moves from a perspective that makes sense. So let's utilize this perspective of one higher time frame range and then one time frame where we're looking for continuation structure away, and let's see how many opportunities we can look to get involved in utilizing the RIMC model. Okay, so we are on the 15-minute chart. Let's just go full screen here now as well. This is the previous sideways range on that higher time frame. Yes, of course, there's a million sideways ranges in here that price can react out from. We don't have to pick every single sideways range. We have a general area that price is going to turn. Now we can wait for price to slow down at this location and look for continuation structures away. Remember, when we're looking for continuation structures, what are we looking for? Well, because this is a higher time frame mitigation and it's a sell range, we're going to be looking for a bearish trend to be created in the market. Again, if you don't know what a trend is, go and look at baby pips. This is not baby pips. This is advanced price action concepts. But we're looking for those lower highs and lower lows to be created within the market. Or the other way that price moves to the downside is very aggressively, where we see initiations, new ranges, initiations, new ranges, and initiations, right? We don't get those deep pullbacks, which means that we're then going to look for those aggressive moves to signal that price doesn't want to create the trend. Then we look for the manipulation, and then we can play continuations. Again, same thing, initiation, which will be very aggressive, like we see here, very strong initiations, very aggressive moves in one direction. We then wait for new sideways ranges, look for manipulation, and play that continuation. Now, we don't have to care about what's the direction of the market, because we already have built the direction of the market from the higher time frame. The only thing that we need to identify on the lower time frames is structure 1 or structure 2. Because these are continuations. Because if price is going to react from a higher time frame mitigation, all we need to see is continuation in that direction. That is building a very high probability trading idea, because we're in flow with what price is telling us that it wants to do. It's telling us it wants to move to the downside. Now, something else we can start to understand before we even get to the continuation structure, because we have to read current price action, right? If you don't know how to read current price action, you need to take the Trading Missing Pieces course. That will teach you how to read current price action. It's all the concepts that we use so that you can actually read what price is doing moving into these locations. So instead of second guessing yourself, you're going to actually be able to read what price is doing. So one of the concepts that we use is, how does price break above the highs? So we can see when price comes into this location here, a lot of traders, where they see this aggressive move and they're looking at this area, they'll just be zooming out, looking at all the areas right here that price could react from, you know, this range, and they'll be trying to play these as reactions here in the future. We don't need to do that. Because how do we know which one price wants to react from? Well, instead of doing that, we can just wait for price to show us that it wants to move in that direction. So here we very clearly see an aggressive market here to the upside. Why would you want to buy an initiation structure to the upside? It doesn't make sense. So instead of doing that, we can wait for price to show that it wants to slow down. So when we're running above highs here and we're not extending in that direction, which means we're getting those strong rejections and moving back in the opposite direction, this is showing that price is slowing down into this location, which is the first sign that something is changing within the market. You see, when we're breaking above these highs here, we're extending and we're seeing continuation. That shows that price wants to continue in that direction. When we start to run above these highs here and we're not extending, that's showing price is slowing down, which is essentially showing that price is creating a sideways range. And sideways ranges and manipulation is where we start to see new intentions coming into the market. So again, price runs above the high and we can play that continuation structure there to the downside on the lower time frames. Again, we have a new high that's created. We see bullish initiation into that high. Then what's really important is about what happens after price takes out the high. Now we know that we're in a sideways range. We didn't extend through this low and we saw continuation here to the upside. So we already know price is contained in this overall sideways range here at this higher time frame mitigation. And what that's saying is that price is about to create a new intention within the market. So even before price even runs above this high and we get those strong rejections, we're already anticipating a potential reversal at this higher time frame sideways range. Now all we're doing here is just breaking down the concepts of RIMC model. So sideways range, initiation, mitigation, continuation, right? All we're doing is identifying this first part now, which is a sideways ranging market. So once we can identify a sideways range, the next phase of price is always the initiation phase within the market. So if we're identifying that we're at a sideways range, where we can potentially turn from, and we're reading the highs as price is running above the highs, and we're not extending, which is showing us that price doesn't want to continue in that direction anymore, we're setting ourselves up for the next biggest move that's going to come in the market, which is always the initiation phase or phase 2 of the RIMC model. I'm telling you, once you can read sideways ranges in the market, and once you understand this highs and lows concept, you're going to be on the right side of the market more often. Because instead of trying to buy this so high or try and play the pullbacks in a sideways range or try and play the 50% of the sideways range, which I know so many traders do, and get caught out trying to look for this RIMC here, you can understand the location of price. You can understand we're not extending, which is telling us price doesn't want to continue. You can understand we're in this phase of price where we're in a sideways range and it's happening at a higher time frame sideways range, which we know is a turning point. So imagine all of those things are stacked in your favor to understand that price wants to turn from this direction. This is what price action reading is all about. This is what advanced price action concepts are all about. It's about understanding the process of one higher time frame sideways range and initiation, which has previously shown the direction. When we've pulled back into that area in the future, we can utilize the lower time frames to show us that price doesn't want to move in that direction anymore by slowing down after we take the highs and not extending. And then because we're also sideways, we know that the next phase of price is going to become that initiation. So when we eventually break out of this sideways range here, we're not looking to play price back into this sideways range. We know that we have clear direction because the next phase of price always has to be the initiation. That's where we can utilize number 1, which is continuation structure, and number 2, which is volatile continuation structure, and we can look to trade that direction within the market. 90% of traders' problems is they're trading against a higher time frame intention. So if you utilize this concept of one higher time frame and then lower time frame continuation structure, and you can read the highs and lows into these locations, this is how you can stay one step ahead of the market and follow the correct intention within the market. Next video I'm going to do on YouTube is how to trade these continuation structures away. But if this concept has helped you, make sure you leave a comment down in the comment section that you want to see that next video, and I'll post that one up in the next few days. Remember, trading is about process. Once you have the correct process, it becomes very, very easy and very simple. All it is reading the price action, applying your process on top, and then everything is about seeing your entries in the session. Simple as that. Trading does not need to be complicated. You don't need to have 20 time frames aligning with each other. One higher time frame and one lower time frame, and then you trade your continuations away. Keep it simple, and I'll catch you guys on the next video. This is one of the best trading mentorship communities in the industry. We have completely updated all of our content. We have a brand new Trading Missing Pieces price action course that breaks down every concept that you see here on YouTube with examples and step-by-step rules and instructions on how to use that concept. And the idea behind the Trading Missing Pieces course is to get your eyes focused on the highest probability locations on the charts so that you can always make sure that you're taking your trades in the highest probability locations and allowing your probabilities to play out. We also have our Flawless Execution Psychology course that breaks down exactly how to trade our strategies in a consistent way, and that is the absolute key to trading success. That is Burton's mental management program, step by step, easy to follow, so that you can gain consistency within your trading. We have everything that you need to take your trading to a consistent profitable level. We have over 25 consistent profitable traders in less than 100 member community. For the industry, that is exceptional considering that there is only a 5% success rate. Our trading community has shown that it's a cut above the rest. If you have any questions before you join, me and Chucks are always available in the website chat. We look forward to welcoming you into one of the best trading communities in the industry.